Today is Tuesday, December 29th, and this is a post-market review for the stock market activities today. I wasn't going to do a full video today, however, some market activities were very interesting today, specifically the reversal from the gap up during the opening of the market. So just when I thought I'm out, they pulled me back in.
Just when I thought I was out, they pulled me back in.
We will discuss the usual when it comes to the options market activities and the heat map analysis, the rotation analysis, the charts analysis, but we have two new charts here to cover. One looking very bullish. Another one is starting to look very bearish. In addition, of course, to the headlines of the day, I have updates for you on the stimulus and market sentiment, very important indicators that we have to pay attention to. With that being said, here we go. The Dow Industrial Average closing in the red by 68.30 points, or a decline of 0.22%. The Nasdaq leading the declines for the day, down 49.20 points, or a loss of 0.38%. The S&P 500 also closing in the red, down by 8.32 points, or a decline of 0.22%. And here are the sector's performances for the day. Leading the pack and capturing the gold, silver, and bronze medal, consumer cyclicals, thanks to the performance of Netflix today. Every other sector closed in the red. Basic materials managed to close just slightly in the green. However, we're not giving any medals for the pathetic performance. Leading the declines of the day, real estate, technology, and industrials. Moving on to the futures market performance. What do we see here? The dollar retreated today, so right away you see the inflationary trade back on the table, and we see crude oil rising by the tune of 1%. Yet we saw the action in metals muted to mixed. We have gold muted, doing nothing at all. Silver declining about 1% for the day. Copper, palladium closing by about half a percentage points to the downside. However, we have an outperformance here from platinum, closing well above 1% for the day. Moving on to softs. What do we see here? Gains across the board, led by OJ and coffee. However, the decliner of the day is coca. We're seeing a calm down in the coca wars, and the squeeze in coca is pretty much over for now. What about meats? Gains for lean hogs, but we see live and feeder cattle declining by the tune of 1% for the session. And here it is again for grains. Massive gains across the board. Whether we're talking about soybean products, whether we're talking about corn, wheat, rough rice, oats, canola. The inflation in food prices is absolutely astonishing. We talk about it every day. Just visit your grocery store and notice how high food prices have climbed. Nobody's talking about this subject. You don't hear it in the news. You don't hear about it from the Fed. You don't hear about it from the business news media. But this will choke the American consumer and households additionally. So when you give them $600, pretty much all of that will go into purchasing food and household items because the prices are too high and nobody is doing a damn thing about it. The Fed keeps saying, oh, inflation is too low and we need to raise inflation higher. Have you looked at food prices, Mr. Jerome Powell? Or is it just wages that you are concerned about? Moving on to the big casino, the options market, and let's see what's going on here. The Apple table remains the hottest table in the casino, scoring over 2 million contracts today. About 75% of those are calls. Absolute insanity in Apple right here. At number 2, Alibaba, and they're betting, of course, on a rebound. We see over 900,000 contracts traded for the day, and again, about 3/4 of those contracts were calls. Of course, traders are betting on a rebound and a short squeeze here. Be careful what you wish for. If you're playing it for a trade, I understand that, but Alibaba as a stock, an investment, is not out of the woods yet. But we see NIO at number 3 with over 700,000 contracts traded today. And again, about 75% of those are calls. You see the insanity here. It's pretty much waking up every day. Retail traders are gambling on call options pretty much every single day, buying the same names, trying to push them higher. Whether it is Apple, Neo, Tesla, Palantir, they're the same names, gambling every day until the game is over. Moving on to some interesting trades and unusual activities for the day. Starting with this bullish spread for the XLE, the energy ETF. And the trader here is buying the 40 calls, expiration date January 29th, and they are paying about 75 cents a piece for this trade. At the same time, they are selling the 43 calls, same expiration date January 29th, and they are collecting about 25 cents a piece from selling those options. All in all, lowering the entry price to about 50 cents a piece with a profit potential of $3 a piece. Very targeted, very smart trade, and we could see the trade becoming profitable and meeting its target if we continue to see declines in the United States dollar. Here is another one, and a very interesting one, a large one that you should pay attention to for the SPY. Somebody here is buying the 351 puts, expiration date January 29th, with expectation that the SPY will decline over 5.5% by then, and they are paying about $3.20 a piece for this trade, bringing the total volume for this trade in terms of dollar amount to almost $7 million. We've been seeing these bearish trades for the indices pretty much buying insurance in very large amounts. $7 million here, $15 million there. You have to ask yourself a question. Why are they buying millions of dollars worth of insurance in January and February if the market is going to continue to rally and melt higher? And here is another interesting one, and it is the same theme for Microsoft. We saw one yesterday. Here is another one. Buying the 242.5 calls, expiration date January 15th, with expectation that Microsoft will climb over 8% by then, and they are paying about 50 cents a piece for this trade, bringing the total amount to about $750,000. Here is an interesting one for Snapchat. It is a bullish spread. Buying the 55 calls, expiration date January 8th, meaning next week, and they are selling the 57 calls, same expiration date. All in all, bringing the total for this trade to about 20 cents a piece, with a profit potential of $2 a piece, meaning 1,000% profit. These are of course wild shots, but the traders are experienced and they know the risk versus reward. They're investing 20 cents a piece with a potential of making $2 a piece. Why not take the shot? This is exactly what the trader is saying. Here is another one for the ticker LAZR, Luminar Technologies, and they are buying the 35 calls, expiration date New Year's Eve. Not a lot of time for this trade to work because they're expecting the name to rally over 8% by then, and they are paying about 60 cents a piece to enter this trade, and it is not a cheap trade. The trader is betting about $500,000 that this trade will work out in a couple of days, New Year's Eve. And here is another wild shot for the ticker IMMR, Emergent Corporation, and this name rallied over 37% for the session, and they are bidding for the squeeze to continue here. This is another Robin Hood's name that they chase. Somebody gives the ticker on TikTok or Reddit, and they pile in all together, creating pumps and dumps, just like we saw in Plug Power, QuantumScape, Neo, etc. And in this case, they're buying the $15 calls, expiration date January 15th, with expectation that the name would rally over 16% by then, and they are paying about 70 cents a piece to enter this trade. We see some notable activities here. A bearish bid for the IWM. We saw weakness in the IWM today, small caps, technical wise, and we will discuss that in the charts analysis. But this is a very interesting trade because they're buying the 177 puts, expiration date February 19th, and we know that historically speaking, February is the worst month for the stock market. They're expecting the IWM to decline over 9% by then, and they are paying about $3 a piece for this trade, bringing the total to over $2 million. Bearish bet against small caps, the IWM. I do like the risk versus reward here because you're investing $3 a piece. And if we see the IWM continues to decline, you could turn it into a spread, you could turn it into a calendar put, and lower your entry price significantly. A very smart trade in terms of structure, but the management of the trade is what will make the difference whether this trade is meeting its maximum profit target or not. And here we see another one for the ticker APA, Apache Corporation, which is an oil and gas drilling company. In this case, they're buying the $15 calls, expiration date February 19th, and they are paying about $1.45 to enter this trade, with expectation that APA will climb over 6% by then. We have a bullish bet for the XLE, and here we have another one for Apache. And of course, the bet is with the vaccines and the reopening, we will see further recovery here in oil prices. Here's another one for Snowflake, and they are betting on a rebound from the losses we've seen on Monday. They're buying the 330 calls, expiration date this upcoming New Year's Eve, December 31st, with expectation that Snowflake would rally over 8.5% by then, and they are paying about $1.10 to enter this trade. This is a wild shot, gambling. Somebody with a lot of money wants to take a hot shot and bet for a rally, a rebound here for Snowflake. Continuing with interesting trades, here we have a bullish call for MGM Resorts. They're buying the 35 calls, expiration date January 29th, with expectation that the name would rally over 14% by then, and they're investing about 50 cents a piece to enter this trade. Here is another one for rocket companies, the ticker RKT, and they are buying the 24 calls, expiration date February 19th, with expectation that the name would rally over 15.5% by then, and they are paying about $1 a piece to enter this trade, and the trader in this case is investing about $400,000 that this bullish trade will work out. And here is, by the way, an example for the stupidity and the options gambling mania. Take a look at the ticker ARCT, and this is for Arcturus Therapeutics. It's a biotech company. And today we had bad news for this company because their COVID vaccine data has been deemed underwhelming, and we saw the stock declining over 50% for the session. Here's a Weisenheimer betting that the stock is going to rebound magically over 18% by January 15th. And the trader is buying the 50 calls, and they are paying about $2.50 to enter this trade. Very expensive because the total invested for this trade is $750,000. There is this dangerous mentality among new retail traders that if things go down significantly, they rebound significantly as well in a V-shaped recovery. How can you blame them? Since they have joined the market during the March bottom, every decline we saw in the market have been recovered in a V-shaped recovery and then some. And you see the same action happening in Alibaba. The stock drops over 16%. They go Naruto style, buying calls, betting for a bounce. Today the stock is bouncing 6%. They feel validated. Tomorrow the stock trades down and they find themselves in a tough spot. And it's the same thing here, whether it's Lunkin Coffee. After the big drop, they said buy the bottom because things don't go down with this magnitude before bouncing quickly. This is the same play here and the same dangerous mentality. When things drop significantly, they're dropping for a reason. And it is not custom that when stocks drop significantly that they have to bounce significantly right away. Matter of fact, it is a trap if you think that way. You might get a lucky streak buying these big drops hoping for a bounce, but in the long term, you will find it as a losing strategy. Moving on to another big trade, very interesting one for T-Mobile. And they are buying the 140 calls, expiration date February 19th, with expectation that T-Mobile will climb over 5% by then, and they are paying about $3.30 to enter this trade, making the total about $1 million. And here is another interesting one for Square. And I say that, here's a teaser, because I am covering the chart of Square during the charts analysis. And they are buying the 200 puts, expiration date this upcoming New Year's Eve, December 31st, with expectation that the name will decline over 6.5% by then, and they are paying about 40 cents a piece for the trade. Keep that in mind when we discuss Square's chart during the charts analysis. But for now, we are moving along to the headlines that shape the day. And right away, we heard from the Fed being very generous here extending their quote-unquote Main Street lending program to January 8th. We know that the program was an absolute failure because the Federal Reserve had a minimum loan amount of 250 grand. Well, Main Street businesses cannot afford to rack in over 250,000 bucks in debt. They need 20,000 bucks here, 30,000 bucks there, 60,000 bucks in certain cases so they can pay their employees and stay open and compensate for business losses due to the lockdowns. But the Federal Reserve, of course, wants an insurance policy that if you are a small business that needs some loans to withstand the storm, you have to have an excellent credit rating and you have to commit to paying back at least 250,000 bucks to the Federal Reserve. But somehow the Federal Reserve is not concerned about these requirements when they shower corporate America with cash. They give cash to the zombie companies, to junk bonds with no questions whatsoever. But when it comes to giving money to Main Street, small businesses, mom and pops, we gotta have all these bureaucracies and requirements that are very hard to attain. Are you again questioning whether the Federal Reserve works for the American people or for a selected elite? The Federal Reserve is not your friend. And speaking of not your friend, here is Mitch McConnell. And of course, the Democrats passed the bill to raise the stimulus payments from 600 bucks to 2,000 bucks to the Senate. And Mitch McConnell rejected the effort. Matter of fact, he blocked the bill from being voted on. Again, do you think this son of a bitch works for you and me, for the people of Kentucky? No, he does not. He works for his overlords, but you morons keep electing him over and over again. And let's move on to some market sentiment news and see what's going on. Here is the first chart I want to show you, and it shows you the contrast between the S&P 500, where it's trading right now, versus corporate profits after taxes. And we are in the widest spread ever, exceeding the dot-com bubble. How do you think that this movie is going to end? The buying opportunity was when corporate earnings exceeded the S&P 500. That was a no-brainer. But now, when we see this divergence, that the stock market marches impulsively higher, meanwhile corporate profits continue to dwindle. Isn't this a recipe for a massive disaster? Keep gambling, bro. Keep playing. They're never gonna announce to you when the game is over. It's gonna happen suddenly and you'll find yourself caught in the trap. Here is more of the euphoria turned into arrogance. The SPY short interest fell to the lowest level since the pre-pandemic drop, meaning the traders and investors are going all in on margin, buying call options, and they're not even considering buying any protection. Talk about arrogance. And by the way, when some of you tell me, don't be so harsh about the Robin Hoodiots, they're too small to be moving the market, it is all these large whales and institutions, you're wrong. Here's the proof. This is the 20 days moving average for call options volume. It is the highest ever in history. We've never seen an explosion in call options gambling like we have seen today. The new entrants to the market, aka the Robin Hoodiots, are not even bothering buying stocks anymore. They're gambling via call options. They think that they have unlocked the easy way to become rich, and they're all going to become billionaires by buying out of the money call options expiring the same week. This is a massive trap in the making. And to illustrate more that the bulk of the call options volume that you've seen in the market every day is coming from small trades, 10 contracts or less, meaning that it is indeed the Robin Hoodiots who are pushing the market impulsively higher. Corporate America and Wall Street are saying, hey, retail, you want to make us richer? You want to push this rally to insane territory? We'll sit here and watch, and we'll support your endeavors when you run out of steam. We're going to continue to gap the market overnight higher for you so you can pick up the tab and continue to march to the slaughter. And at some point, we, Wall Street, going to pull the rug, pull the plug on the game, cash in our profits that you guys made for us, and leave you all in the dust. Another illustration of the mania. Are you familiar with Tesla witch Cathie Woods? Well, the Robin Hoodiots crowd absolutely idealize this lady. For them, Cathie Woods is bigger and better than Warren Buffett. And we have seen insane inflow into Cathie Wood's ETFs, the ticker ARKK. Matter of fact, it was the highest trading volume, the third highest trading volume at some point, just behind the SPY and the Qs, surpassing the trading volume for the entire IWM. Complete insanity here. And of course, ARKK, Cathie Wood's Tesla Witch ETF is a stone cold short for 2021. I will put my money where my mouth is and I will short this ETF and I will show you the trade and the receipts for it. Because these morons, they keep building these quote-unquote gains, and all of what they're doing is they're giving us excellent shorting opportunities so we can ride the ride lower. The difference between shorts and longs ride the escalator up and they continue to watch their gains grow and grow and grow every day, but they get greedy and they wait till the profits go to the moon, bro. What happens is the rug gets pulled, their gains starts to diminish and reduce, and they panic, they sell, they get out with a little bit of profits, sometimes losses, and that is it. The difference is that shorts enter a trade and they have to cover at some point. They have to capture their profits. Shorts get to keep the profits, long often do not, because they get too greedy and they throw the fundamentals out of the window. Moving on to perhaps the most dangerous chart ever. And this will be, remember this chart because it will be the explanation behind the biblical crash that we are about to hit. The margin debt has exploded to pretty much all times highs in terms of percentage change for 8 months. This only happened twice in history. First at the year 2000 during the bust of the dot-com bubble, and in 07-08 before the financial crisis. And now we're seeing it happen again in 2020. The risk and the danger here is that all the mania and euphoria and arrogance in the market in terms of gambling is actually happening on margin, on borrowed money. This is going to be a massive disaster because in the case that algos take over and start flushing down the market, we will see all of these margin calls starting to trigger. A lot of people going to find themselves in a very deep hole, not knowing how to cover the margin. Their brokers will have to sell some of the positions that they have in their accounts to cover the margin call, and you will see a domino effect crash. I've been warning of this for months now, that we will see a domino effect crash due to the margin borrowing mania. And by the way, here is a genius. Market bull Julian Emanuel says stocks look like the 2000 bubble top, but don't fear it. And of course, this is like saying, hey, you're about to fly on the Boeing 737 MAX, and it is going to explode. I saw the future. But don't fear it. Don't worry about it. Go ahead and die. Do these people even think about these statements before they say them? I have no clue anymore. Between the Prozac, the Adderall, the Xanax, and the Oxy, your average American has half of their brain pretty much wiped out. So don't be surprised if you hear statements like this. And speaking of the market mania, I'm betting that you have not had enough of all the IPOs that we had this year. Well, we have more for you. The company 23andMe, this is the DNA testing company, raised over $82.5 million in new funding, and they are thinking about IPOing themselves in the public market. And I say that 23andMe is the future, bro, because you take the test once and then it turns into a subscription service so you can chat with your virtual ape ancestors on the platform. Who doesn't want that? Just put your blindfold on and buy. Moving on to some corporate specific news, starting with Boeing. And we have news about the 737 MAX jet, aka the flying coffin. And today, it finally returned to service in the United States. Now, is this good? Is this bad? Again, your average American with the Prozac, the Xanax, the Adderall, and the Oxy, they're not even gonna care or notice which kind of plane they're flying on. The only risk is if they're cutting corners, we're talking about Boeing here, and another plane explodes, that would be pretty much the end of Boeing as we know it as a company. But the airlines themselves are not out of the woods yet, because we have news from Delta. And Delta canceled over 300 flights just before Christmas after Thanksgiving travel saw a similar number of issues, revealing a troubling trend for the airline. So again, it is a long way for recovery to these airlines, and the only name I would consider an investment in is Southwest, because it is not relying on corporate traveling for the revenue. And here we have some disturbing news about Apple Incorporated, aka the iMob. Surprise, surprise. Explosive report alleges extensive use of forced labor at Apple suppliers in China. And this particular supplier is using slave labor from the Uyghur minority to make glass for the iPhones. And of course, the iMob is only embarrassed because they got caught. You think they don't know what the suppliers are doing, what practices happening over there? They know every detail. They're just embarrassed that they got caught. Of course, Apple pretends to be this woke company that is not putting the charging brick in your new iPhone box because they're quote-unquote trying to save the environment. But all in all, it is another evil corporation that exploits labor, cuts corners, pollute the environment, does every bad deed while putting a massive PR operation to give you the illusion that it is a responsible company. Moving on to Alibaba and the whole fiasco with the Chinese government. And of course, China is hitting Jack Ma very, very hard with all the restrictions on Ant Financial and the expansion of Alibaba's business. Of course, they want to make an example of Jack Ma for future entrepreneurs, that you can be a billionaire in China, you can be very powerful, but be careful of where you are in the hierarchy. Number one is the CCP. You gotta respect that. Don't ever think that you're above the law in China and you can open your mouth and challenge the system openly. And in this case, when people ask me, is Alibaba a buy now? Buy the dip. If you're doing it for a trade, I understand that. I wouldn't personally, but I would not buy the stock either on the dip. The reason is the stock was growing due to the unlimited growth potential for the company. Now when the government is going to put a ceiling on how big this company is going to get, what is the point of investing in a company that has a growth ceiling? I like the name. I like the results. I like the growth in the cloud business. Way bigger than Amazon, way bigger than Microsoft in terms of the growth rate, specifically when you look at valuations. But again, when the Chinese government puts a ceiling on how big this company is going to get, I cannot invest in this company with a solid conscious. And here is the last bit of news for you. Remember in the summer when you went to Home Depot and you bought that ceiling fan? Well, you might want to be careful here because you might be working in your office at the house with your new ceiling fan circling around. All of a sudden, one of the blades gets detached, slashes your neck, and here we go. We have another Final Destination kind of scenario. Because the Florida-based company King of Fans has recalled thousands of its 40 or 54-inch Mara ceiling fans after receiving reports of blades detaching. According to the U.S. Consumer Product Safety Commission, the fans had been sold at Home Depot stores. Maybe they should put these ceiling fans on the Boeing 737 MAX jets. So if the flying coffin doesn't explode, maybe some of the flying blades will get you. And now, moving on to the heat map analysis, and let's see what's going on. Pretty much muted day, mostly in the red with very few exceptions. Let's start with the technology sector. We see that Apple retreated today, massive reversal from the top. Apple closing down over 1%. Microsoft down, but the outperformer is Sony. Sony climbing over 2.5%. We're seeing the Japanese market here breaking out of consolidation, and you're seeing Japanese names such as Sony, Honda, Toyota, all outperforming significantly the last few weeks. But back to the technology sector. We saw a lot of selling yesterday in the hot momentum names. Some of them saw by the dip crowd doing a rescue operation today. Some did not. Some saw an acceleration of the losses. Case in point, Square down over 4% today. Palantir down almost another 4% today. And you see CrowdStrike declining over 3%. Unity Software down over 3%. Trade Desk down almost 1.5%. But we did see a rebound, a very slight one here, for Shopify closing in the green, over 2%. Snowflake closing in the green, almost half a percentage point. But the notable activity here happened in Intel. Intel was the biggest gainer in the technology sector, closing almost 5% in the green, due of course to Dan Loeb. And Dan Loeb issued a statement pretty much saying that Intel needs to look for exit strategies here in terms of diversifying their business. They don't have any business left. If they're not supplying chips to Apple and Microsoft, they're very limited and seeing their market share and their margin disappearing by the day. Intel in a massive world of trouble here, and so is Qualcomm, by the way. Moving on to communication services, the biggest winner here is Netflix. Netflix gaining over 2% of the day. And we are seeing all of these tech giants, whether it's Apple, Microsoft, Amazon, rising from the dead. Yesterday was Apple, today is Netflix, but we are seeing the big tech names breaking out of consolidation. However, is Apple sending an ominous message here that the run in the queues is over? Perhaps, because we've seen a massive reversal today for Apple shares. Back to the coverage of communication services. We see Charter Communications, one of the biggest winner for the day, about 2 percentage points. Zoom, slight rebound, closing in the green, about half a percentage point. But we saw DoorDash declining significantly, over 4.5% for the day. How is that going for you, by the way? All of you who stampeded in buying DoorDash shares. The biggest rebound for the day is for Snapchat, climbing over 6% for the session. Moving on to consumer cyclicals, what do we see here? The Chinese names rebounding, Alibaba over 6%, JD over 5.5%, Neo closing in the green, almost up 5%, Xpeng rebounding and regaining all of the losses from yesterday, closing almost 10% in the green, Li Auto closing 6% in the green. What is lagging here in consumer cyclicals? We see more pain for casinos, cruises, hotels muted for the day. We see Wayfair getting slammed really hard, along with some of the restaurants such as Domino's Pizza, down almost 4% for the session. Moving on to consumer defensives, what do we see here? Muted session all in all, but we saw losses here in tobacco, Tyson, and Cisco. What about REITs? The loser of the day. Massive declines here for retail REITs, whether we're talking about Simon Properties down over 2.5%, whether we're talking about residential REITs, they're all down significantly. What about utilities? Muted action here with the biggest decliner, the PG&E Corporation, down almost 3% for the day. However, the biggest gainer here, it's been an exception, gaining while the rest of the utilities losing. The ticker NGG, National Grid, closing in the green, over 2%. What about basic materials? We have a muted session across the board, and when we shift to industrials, we see a lot of red here with the shipping services, UPS and FedEx down, airlines down for the most part, and we see the big industrials such as Emerson, General Electric, Eaton, Emerson, all down, closing in the red. Even Boeing managed to close just slightly in the green by 0.07%, even after the good news of the resumption of the 737 jet service. What about energy? Also muted session here, mostly in the red, with ExxonMobil as the notable loser here, closing in the red, a little over 1%. Moving on to healthcare, what do we see here? The biggest winners are the giant drug manufacturers, specifically Novartis, closing over 2% for the session. But we saw decent gains here for Amgen, Merck, AbbVie, AstraZeneca, all closing in the green. The laggard section of the day is the biotech names, closing massively in the red. However, we saw Moderna rebounding and closing in the green by over 2.5%. And moving on to financials, what do we see here? Weakness across the board, specifically in regionals. We see that Lloyd Banking Group, the ticker LYG declining another over 5% for the session. Is this stock going down to zero or what? Muted action for the big banks, and when we move to credit services, we see that MasterCard and Visa outperforming, closing in the green, while PayPal losing momentum here, closing about 2% in the red. Profit taking from the hottest names. Very simple. Moving on to the rotation trade. Any significant theme here? No, we don't have. It's a mixed picture. Very muted across the board. In the momentum names, we see a rebound for Shopify, and we see Netflix joining the rally for big tech. Yesterday it was Apple, Facebook, Microsoft the day before, or the week before rather, and now we're seeing Netflix joining the party. Other than that, we see muted action to weakness across the board. When we move across the aisle to the reopening names, it is a similar story here. Profit taking from some of the hottest names: Disney, Six Flags, American Express, MGM Grand, but it is a muted picture all in all. Low volume, no action regarding the rotation trade one way or the other. So let's move on to the charts analysis and see what's going on here. Here is a 15 minutes chart for the SPY. And are we seeing somewhat of a head and shoulder formation indicating a top? The action started with gapping higher to all-time highs and flushing downward right away. The sell-off started right away. You see profit taking, institutionals pump overnight, and you see retail saying thank you so much. We're taking profits here. So for once, retail is doing something good. The question here, is this a topping formation? Well, we're not going to know until we break the support of 369.5. Moving on to the continuous contract and the futures for the SPY. Again, we are battling the upper limit of the range. Failure after failure after failure, rejection after rejection after rejection. And the question is this a sign for persistence, or is it a sign of running out of steam? We see that the volume going down and down and down, meaning that the path for least resistance is upward. The job is really easy. But why is the SPY struggling to break above the upper limit of the range? The answer is it could be running out of steam, but we are not going to know for a fact and have a confirmation that we are reversing lower and we are ready for perhaps a 10% correction until and unless we close below the very important support level of 3,600. Moving on to the Qs. What do we see here? Gapping higher in the morning, being sold off just like the rest of them. However, the Qs managed to outperform the IWM at least. But we are seeing somewhat of a bearish flag formation here from a 15 minutes perspective. Too early to make a conclusion one way or the other, but it is notable weakness for the Qs here. When are we going to know that this weakness is about to morph into something bigger, closing below the support level of 308.5 and closing below the upper trend line that you see in yellow? If we do that, we're perhaps heading into something bigger than just a dip. Moving on to the chart of the day, the IWM. What do we see here? We see a flush down right away, a big one, and we have broken the lower limit of the range. The next stop is 191.5. Breaking below that level, it means goodbye to the rally for the IWM. Hello to shorting the IWM. And let me illustrate that for you from a weekly chart. As you can see, the IWM had a massive winning streak of about 6 weeks. This week, yes, we are still too early, low volume, but we are seeing a reversal signal here from a weekly perspective, indicating further weakness. In addition, take a look at my RSI line on the sand, the 74 level. I've set my alarm for this level. If we hit that level in the IWM, I will start shorting the name. We had that happen early in the morning and during yesterday's trading session, but we are starting to curl downward from that level and getting rejected. Remember, the RSI is a leading indicator. It shows you the weakness of momentum ahead of time before it shows up on the charts. And then you have the MACD, the lagging indicator, showing you confirmation, which we don't have yet. But the weakness is evident if we see a continuation of this kind of activities, closing below 191.5, having a massive red candle weekly candle, it means that the IWM rally is pretty much, for all intents and purposes, over for now. What about the dollar index? Is the bull flag still intact? It is, but tomorrow is a put up or shut up kind of day for the dollar index. We said that about the VIX yesterday. Put up or shut up day for the VIX. Guess what? The VIX decided to put up. We'll cover the VIX chart in a little bit. Will the dollar index put up tomorrow or will it shut up? Critical day for the dollar index. What does that mean for gold? We saw a decline in the US dollar, but gold did not rally impulsively at all. It pretty much closed muted. So is gold indicating what's about to happen? Is gold being too cautious here, saying, I'm not gonna rally? I think the US dollar will rally first and I'm gonna retreat during the dollar rally. Reading the tape tells me that the US dollar has a pop coming. It is not finished yet. Moving on to yields. What do we see here in the TNX? The march continues to the very important psychological level of 1%. Can we fail here before reaching 1%? Yes, we can. It is possible. And it would be a failure in passing the stimulus in time, and that would come hand in hand with a correction in the stock market. However, if I'm reading the tea leaves correctly, I think that the TNX reaching the 1% level would be the trigger for the correction, because at that point 1% is not a significant interest rate to derail corporate valuations and derail the rally, but it is an indicator to what's to come. Since the market, quote unquote, looking forward, if we are going to have a rise in inflation during the reopening, that means that the trajectory for the TNX is to rise well above 1%, meaning that you are going to have to cut corporate valuations, specifically the high growthy kind of stocks. So if I'm reading the tape correctly here, I think that we will hit 1% first and then have a market correction. And this will be one of the triggers. Moving on to the VIX. We said it is a put up or shut up kind of day. The VIX, every time we give it this challenge of a put up or shut up kind of day, the VIX decides to put up. And again, I've been telling you that the VIX chart has been telling me for a long time that it is not ready to retreat to its natural habitat yet. What is the natural habitat? Between 12 and 15. The VIX is saying, I am not done. I have a job to do here, and this job will take me over the 30 level. Until and unless I do that, I am not ready to retreat yet. Further indicating that we're getting closer for a market correction of about 10% or so coming up very, very soon. And here is Apple from a 15 minutes perspective. What do we see here? Peaking above all-time highs at 138, getting rejected right away and flushing down all the way to the closing bell, indicating significant amount of weakness here. The stock is not ready to march above all-time highs. Remember that the stock has been rallying pretty much single-handedly due to the call options mania. When you continue to buy call options, the holders of the stock going to reach a level where they're satisfied with the gains they have made from the stock, and they don't want your 135, your 130 calls to expire in the money. They much rather sell the stock at 138 versus selling the stock at 130. So they are taking profits, dumping on your little head to make sure that your call options are going to expire worthless. And the question here, is this just option writers trying to dilute the stock price as much as they can so they can make as much call options as they can expire worthless? Or is this a bigger message about Apple and the run in the NASDAQ, that it's over and we are ready to reverse? You're not going to know the answer for this question until and unless we start breaking support levels. And the first one in sight is the 131 support level. If we continue to decline tomorrow, closing below 131, that would tell you that the rally in Apple is pretty much over. It is time that you take your profits if you bought the name when I suggested back when it was trading at 113 bucks. What about Tesla? Any action here? Not really. Flat, doing absolutely nothing for the day. It went back to the gap, revisited the gap from last week, closed that gap, it marched higher. That in itself is bullish activities, suggesting that Tesla wants to give it another crack to beat the upper limit of the range. We're not going to be bearish on Tesla until and unless it breaks the support of 599. And here is a chart I want you to think about for Uber. This is a daily chart. We saw weakness in Uber the last few days. trading flat but pretty much in a bull flag formation. So is Uber ready to pop higher in the next few days? The chart is certainly suggesting so, and I'm willing to take the shot and the risk, and I bought call options for Uber. And again, my risk is limited to the call options price. I'm not taking significant risk by buying the stock, and I'm also turning it into a spread, so my profit range is limited, but also my risk range gets limited as well. But I am betting on a pop here for Uber in the next few days. What about the chart that is starting to look a little bearish here? For Square, we see a loss of momentum, and you see a descending line here in the RSI. The stock has lost a lot of its value in the last few days. We do have support for now, so we expect that Square could bounce tomorrow or the next few days. However, if the weakness in momentum continues and I see the name closing below the support level of 197, that would be a shorting signal for me that the name will see another round of sell-off from profit takers. So keep this chart in mind and keep your eyes on the level of 197. Breaking below that level, closing below it significantly, decisively will indicate that the momentum in Square is pretty much fading away. And now let's move on to conclude this video. Again, a reminder, if we do not see significant technical action tomorrow, I will produce a video of my outlook for the next year, 2021. I was intending to do that today. However, we saw some significant technical activities, specifically for the IWM, for Apple, and I had to discuss them for you. With that being said, that's all I got for you today, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.